Welcome back to The Explainer. Today we're digging into a scenario that honestly sounds like a Hollywood thriller, but it's a terrifying, grounded reality documented by leading global institutions. I mean, just think about the web of global trade for a second. We live in this highly connected world where money, fuel, and goods just flow seamlessly across the oceans, right? It keeps civilization humming along. But what happens when you take the single most vital artery on Earth and literally just turn the tap off? The source material we're exploring today paints a truly chilling picture of an interconnected world completely brought to its knees, and the deep, permanent scars it leaves behind. Okay, I want you to just take a second and really let the sheer scale of this absence sink in. Every single day, roughly 130 massive ships used to thread their way through this tiny gap in the Earth. But by March of 2026, that number didn't just dip, it absolutely collapsed down to 6. 6 ships. That is a 95% drop. We're not talking about a minor supply chain hiccup here. According to the data, this was the fastest shutdown of a major trade artery in the history of the modern oil market. The global trade engine didn't just slow down, it hit a brick wall. So to understand how this actually happened, we really have to look at the geography. The Strait of Hormuz is this incredibly tight choke point squeezed right between Iran and Oman. It's just 21 nautical miles wide at its narrowest point. Now, for decades, this stretch of water has been the quiet plumbing of the global economy. You know, it's unglamorous, mostly unseen, and we've all just kind of assumed it would always stay open. But analysts literally call it the world's most important choke point for a very good reason. In global trade, essentially all roads lead through this one, highly specific, incredibly narrow door. And here's exactly why that door matters so much. Before 2026, roughly 25% of all the oil moved by sea passed through this single channel, right alongside 20% of the world's liquefied natural gas. Think about that volume. When you have that much of the world's energy flowing through a gap barely wider than a marathon, squeezing it impacts literally everything downstream. It hits the gas pumps in your neighborhood, fertilizer plants across the globe, massive container ships in major ports, the whole shebang. Absolutely everything relies on this dark blue lane staying open. So how exactly does a theoretical threat turn into a full-blown global crisis? Well, with shocking speed, to be honest. According to the source material, on February 28, 2026, the U.S. and Israel launched coordinated airstrikes targeting military and nuclear facilities in Iran. And then, mere days later, Iran responded with retaliatory missile fire on Israeli cities and U.S. bases. In just a matter of days, literally days, the world's most vital waterway escalated into a highly volatile, active war zone. Which leads us to this incredibly chilling reality. On March 4, 2026, the Iranian Revolutionary Guard Corps made a simple but devastating announcement. They just said, the strait is closed. That was it. That is the exact moment the global supply chain was severed. And look, this wasn't just rhetoric. Within the first 10 days, maritime authorities recorded 10 separate attacks on commercial ships. Tragically, crew members were killed, mines were laid, drone boats were striking tankers in the dark. Suddenly, 20,000 mariners and 2,000 ships were just stranded, completely trapped in the Persian Gulf. But here is where the physical danger instantly translated into total financial paralysis. Because, as you might guess, insurance underwriters do not wait around. The risk monetized overnight. War risk premiums jumped massively, adding roughly $250,000 surcharge just to move a single supertanker through the strait. And when a ship captain is faced with a sudden $250,000 extra fee, and the very real threat of sea mines, they don't push through, they drop anchor, and they wait. That financial wall became just as impenetrable as the physical one. The market shock? It was catastrophic and immediate. Brent crude, which is the global benchmark for oil, blasted past $100 a barrel, peaking at an astonishing $126. The International Energy Agency assessed this not just as a temporary blip, but as the largest disruption to the global oil market in its recorded history. Seriously, to put that into perspective, relative to the size of the market, this was bigger than the massive energy crises of the 1970s. The line on the graph just shot straight up, and the entire world collectively held its breath. But of course, the pain of an economic shock like this never stays contained to a trading floor, right? It ripples out, and it does so very unevenly. In the US, gasoline prices spiked over $1 a gallon almost instantly, and airlines hiked up baggage fees just to try and cover the surging cost of jet fuel. Meanwhile, over in Europe, natural gas prices nearly doubled, forcing central banks to completely panic halt their rate cuts. And in Asia, The impact was incredibly visceral. Bangladesh actually faced recession-like conditions, literally forcing universities to close down early just to conserve electricity. Now, I want to talk about a hidden, devastating casualty of this crisis that most people honestly completely missed. We tend to focus so much on oil, but the strait carries something equally vital to human survival: agriculture. More than 30% of the world's urea, which is the fertilizer that a massive portion of global farming absolutely depends on, flows right through the Strait of Hormuz. Think about the stakes here. Choking off a third of the world's fertilizer right at the beginning of planting season, that threatens crop yields months before a single loaf of bread even has a chance to hit grocery store shelves. Economists call this an asymmetric shock. Basically, that means the exact same event hits different parts of the world in vastly different ways. For a household in an advanced economy, food makes up about 12% of their spending. A price spike is super frustrating, sure, it hurts the wallet, but in low-income countries, food accounts for 43% of all household spending. For those families, a fertilizer shock originating in the Middle East isn't just an inconvenience, it's an absolute catastrophe. It is the razor-thin line between stability and a full-blown hunger crisis. So when institutions actually tried to model the fallout of all this, the projections were incredibly grim. Wood Mackenzie laid out the scenarios, and even in their optimistic base case, which assumed a short disruption, global GDP growth falls below 2%. That's a painful global recession. But their worst-case scenario, that's the one that kept analysts awake at night. If the street state closed through the end of the year, oil was modeled to hit $200 a barrel, which would actively shrink the global economy. They were staring down the terrifying possibility of the third global recession of this century. And compounding all of this is a horrifying reality highlighted by the UN. Roughly 3.4 billion people live in countries that currently spend more money servicing their national debt than they do on health or education combined. That is nearly half the planet's population. When the Strait of Hormuz closed, half the world had absolutely zero fiscal cushion left. There was literally no money in the piggy bank to subsidize fuel, hand out food relief, or absorb a shock of this magnitude. But crises like this, they always carry a bitter irony, don't they? In a supply shock, the choke point decides who profits and who pays. During the first months of this crisis, the United States gained the roughly $50 billion in extra export revenue, and Russia gained $15 billion, basically stepping in to sell their own energy into the gap. Meanwhile, the Gulf nations, sitting right next to the disruption, saw a massive net decline in revenue. Because even with oil prices sky high, it didn't matter. Producing oil means absolutely nothing if your ships are geographically trapped in port. By late June of 2026, the source reports that a fragile ceasefire finally allowed the strait to slowly reopen. Ships began moving again, albeit under heavy escort. But the core takeaway here is that economic scars don't just magically disappear when the headlines change. Inflation forecasts stayed elevated for a long time. Central banks remained highly cautious. The damage was already set in stone. We were handed fresh, undeniable proof that a massive share of human civilization relies entirely on a tiny gap in the ocean. Which leaves us with this haunting question. We no longer have to wonder if a single 21-mile strait can shut down the global economy. We know it can, because it did. The vulnerability is entirely real, and it remains entirely unresolved today. The extreme fragility of our modern world is just sitting right out there in the open water. The only question left is what happens the next time someone decides to do it on purpose.